Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Erik Wetterling, and we're going to be talking more portfolio management, the type of stocks that Erik is buying in the resource sector. Look, undoubtedly we have a bull market here for metals, a lot of different metals, as gold continues to break out to all-time highs. Silver is above $30. Copper is holding above $5. And quite frankly, these stocks, there's a lot of stocks that are well off of their lows of just a few months ago, let alone in Q3, Q4 of last year. So Erik is the founder and editor of the Hedgeless Horseman. Now, Erik, look, we were talking portfolio management with you off mic, and you were breaking down the type of companies that you're investing in to ride out undoubtedly volatility in these bull markets, but also take advantage of finally a bull market that we have in the precious metals that is now a few months long, and the breakouts that we're seeing in a number of different metals are further confirming that this market has momentum to the upside. So Erik, portfolio management wise, what stocks are you focusing your portfolio on right now?
So it's like the thing with me, I'm always fully invested, which means I have to have a strategy that works in any weather, kind of. And okay, how do I get myself to buy low? That's because I'm bullish on the specific companies. I see the metal prices as a bonus, not a requirement, let's say. I mean, otherwise you would be trading sardines, basically. But yes, recently I've said that beta is the has never had better risk reward in the last, I don't know, since 2015, I think, even maybe back to 2003. But my point is, like, right now, when we saw that on Friday, and we're seeing that in the futures market today, I mean, the metals are on fire, especially silver, which is the most, I don't know, psychologically charged metal there is, and the juniors are also psychologically charged. So when you see these kind of moves, you see what can happen in the junior space with the silver juniors, for example. Some have gone absolutely ballistic. Some are up 100 to 300% from the bottom without much happening for the companies per se in terms of fundamentals. So it's very natural because we're seeing FOMO is starting to build. And that's, of course, goes back to the fact that nobody actually wants to buy cheap. They want to buy what's going up. Now stuff is starting to go up. So now people are getting bullish. But my thing, or what I've been reflecting on, is yes, of course, when you see silver ramping and you see all these charts out with $50 silver and $150 cup and handle targets and what have you, it's of course hard to resist. So yeah, maybe I should put my entire portfolio into silver beta, because if that happens, silver juniors should do really well. But my point and what I come back to is that even in a really good bull leg for juniors, even in a full-blown bull market that spans years, there's going to be a ton of corrections. There's going to be a ton of consolidation, times of consolidation. The actual spurts, I would say, I mean, the rallies when the price goes materially higher, let's say from yesterday's close or a week old close, is typically maybe 20% of the time. So my point is that yes, I mean, if this is a start of a raging bull, a lot of the beta is gonna go maybe much higher, especially if it's not a bull leg, but actually a long-term or longer-term gold bull. My point is I hope people already consider how they're gonna feel, what they wanna feel like doing when we have these plentiful corrections and consolidation periods, because it's really fun and easy to be buying and be in high beta stocks during up days. Thing is that there's going to be a lot of down days and long or several periods of consolidation. So my, I guess, tip would be that know what you're doing, have a strategy that makes sense, and you can actually enforce, even if this is a bull leg or a bull market. That, I mean, for me personally, that's why I go back to stock picking all the time. And that's why I want good companies that I think are cheap, like really cheap. They actually have value. They don't have silver or gold or copper in their name, because as soon as we get some negative volatility, I'm going to feel like a dumbass. I'm going to feel like I should be selling. I'm going to read on Twitter that the next target for the metals is down. Then I'm going to start to be pricing in the fact that the stocks I own are going to go down, and then that's going to want me to sell, not buy low, for example.
Well, Erik, we've talked about this a lot in the months leading up to this, and last year and the year before that. It seems like that you've always been in the value investing camp, and you've always been a stock picker looking for really more alpha than beta. You've always been focused on catalysts that are going to drive companies higher. Maybe break down a little more specifically some of the characteristics in companies that you think will be all-weather stocks and make it through those volatility and corrective periods versus the tendencies to get in the Momo trades and get in the optionality trades. Maybe break down the difference in the characteristics in the companies you're looking at to weather the whole bull market.
So I would say the ones that encapsulate, or I think had the best risk reward, not from only a long-term, let's say, performance viewpoint, but that I could feel, okay, I can actually ride a bull market in these. I can't ride a full bull market in pure trading sardines. That just doesn't sit well with me. Because then you have to trade as well, because they're going to get overvalued. Let's say an ounce in the ground for gold goes from 20 to 100, then you have to sell that, obviously, even if you think, hey, the gold in the ground is going to go to $200. So recently when I talked about, oh, beta is getting better and better, I still want to primarily focus, and that's not saying that I only own those kinds of companies, but if I see companies with ounces in the ground, quality ounces in the ground, that have a shot of actually having a legit project, but also with a long pipeline of growth, either it's like big project, at least hopefully probable growth, whatever, because that's going to get me to stay in the game, let's say, that I think, oh, this is just going to get better. So even if the metals start to trade sideways or slightly down, I think, hey, over the next 2 years, this company might have proven up 200% more ounces or whatever. So in that case, it's even if in a relatively boring sector, maybe they will create more value, that the actual value creation is outpacing the whatever sentiment discount from a lower metal price. Since, I mean, honestly, I mean, what does it matter what gold and silver is doing today if you have a mine that's going to be in operation in 10 years? It doesn't make sense, but that's how this market function. So I like that stuff. Like, the worst thing, of course, is if you buy into the bottom, let's say sentiment bottom in juniors, and you're only in high risk alpha. Worst case scenario, you end up with, or you have a bunch of pre-discovery plays, they end up finding nothing. So when the inevitable bull comes, like it looks like what's happening right now, you missed out on everything because you didn't even have any ounces to revalue. But at the same time, if you have some ounces in the ground, okay, those ounces are not going to get undrilled. So that company's going to have some beta. It's not going to have the highest beta like a shitco. But if we go to the volatility phase on negative days or consolidations, whatever, you're not going to feel dumb, or at least for me, I'm not going to feel like I want to sell, because I'm thinking, well, okay, they have ounces in the ground now, but in time, 1 year from now, 2 years from now, this company is just going to be even better. So I'm already like living, let's say, 1-2 years from now and thinking that, okay, at price X today, that's going to look very cheap in 2 years from what the company itself can do. So then you're thinking, if a dip comes and you're thinking, well, I think this is going to be worth whatever, 500 million in 2 years, and it's trading for 100 million now, it goes down to 80 million. Then I'm bullish again from looking further ahead than the market does. So it's like, that's the best way, I think. It makes sense. You're not going to make the most amount of money in the uptrend. I'm certainly not going to have the best performing portfolio, but I still think I have a portfolio that makes sense, and especially one that allows me to actually be on board on a volatile bull.
Okay, so you are looking for companies that have ounces in the ground, so some sort of an asset, and you're also looking for growth. How do you balance out then, Erik? You obviously like drilling and growth in terms of resource size. How do you look at companies that have a resource that are going through different economic studies or permitting, trying to de-risk the project on that end rather than simply just drilling growth?
Well, I mean, that's, I wouldn't say my edge, for example, is not trying to appreciate how good a very advanced stage developer is going to be, for example. I mean, let's say I don't mind if, some companies like, yeah, we know we have ounces in the ground, but we're just going to keep drilling, because it's hard to kill a dream if you don't, let the rubber hit the road, speak. So I would say, and also that It's like I have some early stage exploration companies as well. It's like anything that's of value or I think is cheap on a risk reward basis that I like. But still, it's like I'm into some early stage copper explorers because I find it so hard to evaluate what a good copper project is personally. So I'm sticking to, okay, if you have a really cheap or lowly valued pure exploration company and you put, I don't know, 0.3% of your portfolio in it, it's going to go up regardless if maybe the project actually is not going to work out in the end. But if they hit something, it's still going to go up. So I'm guessing I'm trying to avoid, let's say, juniors with too hard questions being asked that can risk killing the story typically. Because again, I'm not a mining engineer. So if there's a company who's, oh, the only thing that's going to happen for them is that they're going to put this mine into production. If I don't feel sure that they'll actually be able to do that, because we've seen a bunch of developers hit the graveyard last 2 years, for example, and it's getting harder and harder, costs are up, whatever. So I'm just trying to make it as easy for me as possible. I actually don't want necessarily them to be that advanced that they have to ask really hard questions where basically expectations meet reality. So if you have some ounces in the ground and they keep drilling, how do you kill that story really? Because you're not going to test how good that deposit actually is in real life, and you don't need to bet on, let's say, maybe a management team you're not sure if they will actually be able to pull it off. So I don't know if I'm answering that correctly, but I'm trying to avoid story killers, let's say, unless it's early stage exploration where all there is drilling. But in those cases, at least I want them to be small enough positions, typically, that it doesn't really matter. And if you can get into private placements, like I've been in some early stage exploration plays recently, because I know most of them, 80% are not going to find something of value. But the few that do, because they're so cheap now, I guess I'm going back to the fact that I'm not only in beta, I'm not only in alpha and beta. I look at value across the board, and I'm just trying to keep myself out of trouble, let's say, because drill risk I understand, but engineering risk I don't.
Well, Erik, let's dive into that about the drill risk, because we've had a lot of discussions about pre-discovery stories versus post-discovery stories, and you've made it clear that you'll invest in both of them, but that the lion's share of what you were doing was looking at post-discovery stories after they've had a significant drill hit and that makes people look at the property more seriously. You're looking at the second campaign, the third campaign, and what are the next 30 drill releases, drill news releases look like. And so you've made that point before. Maybe speak to that you're not really looking at the, like you say, the super advanced developers, but if it's an advanced explorer that's made a discovery, you're looking at companies that can grow. How does that contrast with how you would play a pre-discovery story right now where they don't have any ounces in the ground yet?
Yeah, I mean, like I said, I think a couple of times over the last few or several months, I'm as the sector went cheaper, I was like favoring beta, proven success more and more over pre-discovery, because like I was going to say always, that success that's not going to get undrilled and it's going to go up when the tide comes in. But of course, if you kill a project from pre-discovery play, you're not going to have any safety net. There's no sentiment that's going to, if you kill your project, sentiment turns around. Do you think that stock is going to go up 600% without any real product? No, I don't think so. And from a risk reward perspective, it typically, especially in a bear market, it makes a lot of sense to go post discovery, because as we've seen, that might be changing now though. Even if a company did a discovery hole or drilled some good holes, nobody gave two shits. So it was like investing as an insider. So why? So in essence, in reality, it's rigged against the risk taker, because if you take drill risk, it comes out favorably, the actual results, you don't get paid for it. Anybody could buy in the next day without taking the risk of failure. But if they missed, you get slammed. So that's from a risk reward perspective, that doesn't make much sense. But and that's why I kept telling, it's like, hey, even if you pay up 100% after a discovery hole, for example, that's probably much, much better risk reward than being in pre-discovery and the only patented gains you get was 100%, because that's not going to offset the risk you took especially in a bad market. Because let's say it's 5% chance of a solid discovery hole that gets a company to revalue 100%, 5%. Okay, so 95% chance of failure, and you get 100% patented return if you're lucky and the results are favorable. That doesn't add up at all. So it's like that's the stuff I want to see right now. It's like probable growth, long pipeline for growth. I don't want typically to see companies right now needing in the future to go out and buy growth, because we know real estate is going to go up one day. I'm thinking for my longer term holdings, for example, I prefer the ones where you get ounces in the ground. Maybe they have half a project, but they have probable growth, and the only questions they're really gonna typically be asking, let's say, is with the drill bit. And if they have a long pipeline for growth, they have these district scale land packages, whatever. Theoretically, they could grow for a long time. And in a bull market, people are going to pay up for that potential, because now in a bear market, potential doesn't get any value at all. That's going to happen someday. And in the meantime, if they have ounces in the ground, they're not going to get undrilled. So you're making sure that you're probably going to get the sentiment boost, not like a super high pure beta, but you also have that kind of long-lasting potential for revaluation. Whereas if you're bullish on the company fundamentals over the next 4 years, theoretically you could sit on your ass for the next 4 years, especially if you started off paying cheap. Contrast that to buying in after these trading sardines are up 400% because you think, well, they might double again or whatever. Yeah, they might. But it's like in time, you're probably, as with all trading sardines, they go up and then they crash. They go up, then they crash, don't create any value. So how is that going to give me any sort of staying power? Because I'm going to be paranoid all the time that we're near some top.
Yeah, well, trading sardines, those ones, they're volatile, right? But they can move in these bull markets, and it seems like we are in a bull market. Erik, since you are, it seems like still so focused on some early stage explorers, how do you go about analyzing early drill results? When you talk about a new discovery being made, we hear different variations of that, where sometimes the market takes notice and it clearly is a almost company making hole that's drilled. But a lot of time we hear from management teams, we're seeing the smoke. We maybe didn't hit the fire, but we're seeing some of the metals we like. We need to go back and test some more of it. And the market hasn't really responded to the back of those initial results. What are some of your characteristics that you look for in early on so-called discoveries?
Well, I mean, the more material, the better. And let's not forget, if we go into a high sentiment environment, really high sentiment, like 2016, we saw companies trade up to 100 millions of market cap without even the first assay result. We saw soil samples get 50 million market cap valuations. Some of them might have traded for 5 million last 1-2 months or whatever. I guess that's really hard. I mean, like now, for example, I think the drill result needs to be absolutely exceptional for me to think that they provide better risk reward than already proven cases. And in terms of pre-discovery plays, I want tier 1 potential. Otherwise, I'm not going to play that. I'd rather buy the ones with potential tier 2, where there's a discovery, it might turn into a tier 2 mine or whatever. If we're talking pre-discovery, I think you have to, because everything else is so cheap, like the bank success, whatever, that if you're going to bet on pre-discovery plays, yeah, you need to swing really big, because you can buy the 98% of the lower categories for maybe less than sunk cost still. Yeah, I'm going to say that's very hard. I haven't really seen, I don't remember last time I actually bought into just a discovery hole. So it's hard to answer that. But if you see something that simply doesn't come around every day, I'm talking about Snowline Gold, for example. I mean, that's probably the latest one I actually went really big on. But that's because they hit such good holes so early on. That really stood out. And something really has to stand out. And then you, of course, have to go back to the price you're paying. I mean, even the best hole, if it trades up too much, makes little sense. I mean, would you pay 150 million for a post-discovery story if you can buy a tier 2, tier 3 project for 50 million in this kind of environment? Maybe, but I'm not 100% sure I would do that. So I'm going to say that, yeah, I don't know actually. It depends on what everything else is trading at, because that's the opportunity cost all the time.
Okay, fair enough, Erik. I just think we hear so much about this is a discovery, but the market didn't move on it. And when you have holes like Snowline did, that was clearly a discovery that just kept on going and continues to go. But Yeah, look, it sounds like you're very much focused still on these companies that have growth ahead of them with the drill bit. It's what you specialize in. And right now, these companies are going to have more money to drill. So let's hope that they do hit some interesting mineralization. Let's hope we just don't get more ounces in the ground just for the sake of having more ounces in the ground, because we have a lot of ounces in the ground right now. We need ounces that truly move the needle. But that all can help with a rising tide environment, which we have and are in right now. Erik, thank you as always for your time. We'll post a link to your website where everyone can stay up to date with the companies you are writing about. We'll also chat with you next week. So have a great rest of your week there, Erik.
The same. Thanks, guys.